Hi, this afternoon I'm joined by Martin Crabb, who's Shaw and Partners Chief Investment Officer. Martin's just been over to London for a international investment conference put on by EFG, and today I thought it was a really good opportunity to sit down and get some of your thoughts on what played out over in the event. You've been there for a week or so.
Yeah.
Surely some substance came out in an event like that, flying over there first class, no doubt, to take part in it. I guess, what was the crux of the event? What did you take away from it initially? Then I'll drill into some of the key areas
for sure.
of discussion.
So I think from the investment side, there's obviously a clear consensus amongst a lot of market participants that it's going to be another good year for investment markets and equity markets in particular.
Surely we can't sit back here with rose-coloured glasses like that after we had 20% in most equity markets around the world last year. No one was predicting that in December of last year, so this time is different because...
I think 2019 wasn't just good for equity markets, it was good for everything, right? It just doesn't really matter if you're in bonds or equities or whatever. But I think everyone sees a continuation of the conditions that led to the strong returns from last year. So we've got accommodative monetary policy. So all the central banks globally are either on hold or cutting. And we've already seen a cut from the Reserve Bank of South Africa last week. We've got, the end of austerity. So austerity has been a huge issue around the world, including in Australia. So we're seeing an end to that. So we're seeing governments start to spend money. And we've got, improving world growth. So world growth got knocked around on the back of trade last year. Hopefully we've now got a resolution or some sort of resolution between China and the US, which should see trade and therefore world growth improve. So all the conditions that you need for a better equity market are in place. My question would be, we've already seen that in the first 3 weeks of the year. But certainly the view from investors at the conference was, this year should be reasonably good for markets.
So IMF has come out and they forecast global growth at 3.3%. I believe they ratcheted it back slightly overnight. How do you reconcile that backdrop of an uplift in global growth, central banks remaining on hold, then you've got a really benign inflation outlook as well. And liquidity, I think, is one of the really underestimated parts of this rally. We saw in December quarter of 2018, where that tightening of monetary policy, the reduced liquidity in the market, led to shares 10 to 15% down in the quarter. So I guess I'm from a contrarian point of view. If the whole world thinks we're going in one direction. What's the counter argument to that?
And that's the thing that keeps me as CEO of Shaw and Partners up at night as well. It's like, okay, well, everyone thinks the world's great and conditions are perfect for equity markets, so let's just buy markets. You kind of go, well, if everyone's already thinking that, and I was at a conference with 100 different people from around the world, and they were all thinking that, surely that's already in the price. So what can go wrong? So I think the issue that we need to think about as investors is, how diversified am I, and what measures do I have in place to protect me if my central theme doesn't work out? So what could go wrong? It could be something to do with US politics. It could be something to do with oil and the Middle East tensions. It could be something to do with Europe-US trade tensions. There's a whole bunch of things that could emerge that would get markets nervous. And as you said, when everyone's rushing for the exit, it can get a little bit crowded, and we've seen that in markets before with the repo market in the US, for example. So I think it's just about having some protection in place, and whether that's holding a bit more cash, or it's having some derivative strategies, which would be ideal, or just having a really well diversified portfolio. We know that Aussie investors are terribly undiversified. They've got term deposits, bank shares, and some property, and that's about it. We don't have global equities, we don't have bonds, we don't have emerging markets. So I think adding some of those more diversified structures and products into the portfolio is a really good way to manage it.
Really good point. So around investing overseas, so US markets had a really stellar run over the last year, but for the last decade, really largely outpacing our market. What areas are starting to look interesting from a global perspective? We've got the UK has now got a pretty robust government in place. Emerging markets are starting to show some better growth. If we do see stabilisation of the US dollar, stabilisation in interest rates, surely that's beneficial for emerging markets.
I think you've hit on the two, from my perspective, most attractive markets, which would be the UK. And I think for the reasons that you point out, we've now got a very strong mandate, and we've got a government that looks like it's going to go and spend some money. And then we've got a central bank that's going to cut rates. So all that looks reasonably good for the UK, but it is a small part of the world market. I think emerging markets also, as you mentioned last year, they got knocked around because they are the ones that were impacted by the China-US trade war. It wasn't really impacting China or the US. Both of them were sailing ahead. It's more the guys that got caught in the middle. So I think places like Singapore, Hong Kong, Vietnam, Thailand, Indonesia, those Southeast Asian Pacific countries look reasonably attractive from a valuation perspective. They should get a lift higher. And there's ways you can just buy the emerging market basket on the exchange. So I think that's quite a good idea.
Yeah, IEM is an ETF there for the emerging market.
Yep.
So in terms of drilling down into areas that were discussed at the event, so obviously, tech's been a massive driver of global markets and, global performance of US markets in particular. What other areas of, interesting sectors, if you like, got spoken about at the event?
There was a big debate between two very highly rated analysts about the electrical vehicle space. I mean, it was actually more broad than that. There was an auto analyst and there was a technology analyst. The technology analyst spoke about 5G and cloud and telco cloud, and how a lot of telco companies were spending a lot of money on making cloud computing a lot easier and approachable for their clients. So investing in 5G technology is part of that. We then got a big discussion around EV and how much of an advantage Tesla had over its competitors, and the fact that the competitors are only now coming out with products that were catching up with Tesla's 2012 model. So they got a big sort of leeway in technology. But then we had the auto guy saying Tesla's massively overvalued because if you compare it to Volkswagen and these other names, surely they're catching up.
But is that the old school way of thinking? I mean, if you think about a business like Telstra, if you think about a business like Google and some of these other technology business, it seems to me that you need massive investment to get ahead of the others. It's sort of that premise that the winner takes all, the network effect, if you like, of businesses who do the groundwork, who get ahead of the others. They then have the capacity to monetize that. Apple was an example of it. We look at Apple was a heavily overvalued company for a lot of years. Now it trades on 14 times as the world's biggest company because it's done the hard yards since then. I guess that also brings into discussion valuations locally. So if I look at the Aussie market here, we're on 15.5 times at the start of 19. We finished the year close to 20 times. How do you reconcile that? So is it simply a case of our businesses have slightly changed, or it's the impact of lower rates? And can we tolerate higher valuations in that backdrop?
And look, it's very difficult. I mean, I like to not look at the market as a whole, but to break it up into macro sectors. I look at resources, I look at banks, and then I look at everything else. And they're not roughly a third, but let's assume that they are. So a third of the market's financials or banks, and they're trading around sort of 13, 14 times, which is an earnings yield of, say, 7% after tax.
Cheap, right?
Yeah, well, you look at compared to bonds, that's not bad. From that, they can pay a reasonably healthy dividend yield. So you're going to do reasonably well. The banks are going to be choppy and noisy, and they're going to have more issues, as we know, but you're going to get paid a reasonable yield. You go resources, and that's just really a call on global growth in China and iron ore in particular. But again, valuations don't look incredibly expensive, particularly if you look at this year's earnings. Next year, they might get a bit expensive. But the whole market's got commodity prices declining. Maybe they don't. So maybe resources look okay. Where I get scared, James, is industrials ex banks, looking at 28 times forward earnings. And you look into it, yes, there's some great businesses. CSL's a great business. Some of these buy now, pay later stories, they're fantastic growth, etc. What do you pay for that? But there's a lot of companies in there that are just ho-hum, that are like Woolworths and so forth, are trading 23, 24, 25 times earnings. That's a 4% earnings yield in a boring business. That doesn't excite me too much.
Well, I guess that's a function of, they're the areas of the market that will struggle if interest rates start to appreciate.
Yeah, so, exactly.
Now we see it on the desk. Investors are forced to go up that risk spectrum. So, my own personal view would be that there's traditional bond investors who have sort of translated into bond-like equities, Woolies, Transurban, Sydney Airports of this world, which obviously creates a risk in this point in the cycle. So you touched on the resource trade. I'm interested to see this. So if the consensus view is that interest rates stay stable, liquidity is still going into the system, what happens with inflation? Inflation's been really stubborn. If we get inflation, that's going to be bullish for resources. Is that sort of an outlier event that's not being priced by the market?
Yeah, I think the presumption is that no matter what central banks do, they can't ignite inflation. So they can print money, they can make rates negative, and it doesn't change anything. And I think that's a dangerous assumption, because if you look at the march of human history, the inflation gets caused when you print too much money. So yes, there are some rather tectonic forces that are keeping inflation down, but will they always be there? Will they always be to the extent that they have been? Will we have as much globalisation? Will we have as much technological development? And our demographics are kind of locked in, but the first two, I think the market can get a little bit caught up in itself. So I think, again, coming back to this, what could go wrong and how do you hedge it? Let's assume there is some inflation. Like, no one could see it, but it comes, and the central banks go, whoa, we have to do something about this. And maybe it's a tariff war that causes it, maybe it's something else, I don't know. You need to have some exposure to things that go up when inflation goes up. So that can be CPI-linked bonds if you're more defensive. It can be something like gold, or it could just be industrial commodities. So we'd have a bit of all of that in a diversified portfolio.
So you come away from the event, what's your baseline for 2020? Do you think it's going to be a reasonable year, a great year, an average year?
Yeah, I think I'd like to break it into two halves, if I may. So the first half of the year, I think we've got the tailwinds from improving growth. We're going to have central banks continuing to cut, including in Australia. We might get Reserve Bank cutting. So I think the first half of the year looks okay. The second half of the year is all going to be about the US election. And I think there's a lot more uncertainty about what could happen than markets are pricing in. So I think make money while the sun shines in the first half of the year, but get ready to take some money off the table.
So going into that US election, there's the thesis is that it's going to be, markets will remain supported. Trump is going to be keen to get the economy rocking and rolling going into an election. Strong economic growth, low unemployment, etc. That gets presidents re-elected. What if that doesn't happen? So what if the Democratic Party starts to firm in the polls? What if we get a left field event like Elizabeth Warren coming to the fore? What happens to markets in that regard? And can the Fed underpin that to some degree?
Yeah. Well, the view in the markets very, very simplistically is if you get a left-wing candidate like Bernie Sanders or Elizabeth Warren winning the election, it's bad for markets because they want to break up tech and they're not as pro-healthcare, et cetera, et cetera. So I think the markets would certainly take that as a negative. So if there's a view that that's more probable as we go into the second half of the year, you will see markets get nervous about that. Whether it actually happens or not, it's a different thing. But everyone just thinks, A, we're going to get Trump, and B, that Trump's going to be pro-markets in his second term. And either of those things could change quite quickly.
So if the status quo maintains, the market's going to have a reasonable year in 2020 like it did in 2019, but there are a few left field events coming at the back end of 2020. Martin Crabb, thanks very much for joining me.
Great talking to you.